Good afternoon, and welcome to the Prince George's Community Federal Credit Union 2018 Lunch and Learn series. Today's presentation is brought to you in partnership with Coffee, a nationwide financial coaching and education center focusing on improving the financial health of individuals. As the premier credit union of Prince George's County, they have joined with Coffee to expand their mission of providing quality financial education to their community and lending insight into credit management, home ownership, and money management. Prince George's Community Federal Credit Union is a full service financial institution serving anyone who lives, works, or worships in Prince George's County, Maryland. They are one of the county's best kept secrets with competitive loan and savings rates as well as discounts to national retailers. They currently serve over 16,000 members in the area and welcome you to come and experience the benefits of membership as well. Later on in the presentation, I will display their contact information and answer any specific questions you may have concerning your financial needs. It's not too late to invite your friends and colleagues to join today's presentation. You should have received an email about 60 minutes ago, and in that email is a link that you can pass along. Please note that today's webinar is live and all phone lines have been muted. If you have questions, please feel free to type it into the question box on the right-hand side of your menu bar. All questions are private and will be addressed at the end of our discussion. We will be offering a free 60-minute financial coaching session with the completion of 3 webinars. More information will be given at the end of today's presentation. Lastly, a recording of today's session will be available later on today. Details will be sent to your email following the presentation. And with all of that being said, I would like to introduce myself. My name is Charmaine Williams, and I will be your presenter today. So I want to thank you again for joining us on preparing your finances for a mortgage lender. Now, to get started, there are some steps to home ownership. They include setting goals, which in this case would be purchasing a home, addressing any credit issues you may have. The next is developing and maintaining a budget. And lastly, meeting with a HUD-approved housing counselor and taking a home buyer workshop. Now, these are all very important steps to take because you want to be ready when you get to your lender and submit your application. But today's main focus, I'm going to talk about steps 2 and 3, which are credit and budgeting. So the first thing is credit. This is one of the most important things when it comes to buying a house. Without having your credit in order, you will not be qualified for anything at your bank or credit union. If you were on the previous webinar, you will have an idea of what your lender will be looking for. And you can always call and speak to a loan officer at Prince George's Community Federal Credit Union if you have any additional questions. But before you go in for your pre-approval, you will definitely need to get your credit in order. So first things first, how is your credit? How many of you know what your credit score is right now? And not by checking sites like Credit Karma or Credit Sesame. I mean what your actual FICO score is, because that is what the lender is going to be checking. When was the last time you pulled your credit report? Believe me, your lender will be pulling that report and checking that score the minute you sign that application. So that means you have to know what is on your report and where your score is at. And I'll discuss what factors affect your FICO score. Now, some people have excellent credit, others not so good. Then there are a few with bad credit or no credit or a thin credit file. So if you're in the excellent to good credit category, then you will obviously need to maintain that. If you are in the thin or fair or poor credit category, then you'll need to take control and work on your credit issues or establishing some credit. If you have no credit at all, this is where you need to start. Now I'm going to get deep into credit because we'll be discussing credit in greater detail in the next few slides. So, soon as people hear credit, they think of that 3-digit number. Now your credit score is important, of course, because it's what lenders use to assess your credit risk. But your credit score is directly affected by what's being reported on your credit report. So when you pull your credit report from annualcreditreport.com, You're only going to get your credit report and not the score. Yes, you can obtain your score from a number of different channels, but it's more likely than not that you'll have to pay. There are some lenders, banking institutions, and credit unions that will offer you a free credit score, but typically it's usually from just one of the credit bureaus. Now, again, please remember that before you focus on what your score is, you need to know what's on your credit report. And you're going to want to go over your credit report with a fine tooth comb because, again, the information on your report directly affects your score. Make sure to check that the information on your report is accurate, from how they spelled your name to any accounts that you have or that don't look familiar to you, to any inquiries, again, that you may have put processed or inquiries that you know you didn't apply for. So those are the things that you're wanting to look at. You can and should dispute items that are not yours or that are inaccurate. You can either write to them or you can do the dispute online. Now, if you're going to write to them, you need to make sure you're sending your mail, certified return receipt. Yes, we are in the technology age and doing everything online is easier and more convenient. Each bureau has their own website, and on each site gives you the option to dispute. But I always recommend doing it the old fashioned way, snail mail. Send it off, certified return receipt. Make sure you keep copies of everything. This way you know you have it at your fingertips. So, discussing what was on your report, again, going over it, making sure it's accurate, all the information that's being reported is correct, knowing that the accounts do belong to you, knowing that your addresses are right, your name is spelled right, the employment that they have listed for you is right, all of the inquiries you recognize, the public records you recognize. Okay, and those are all the things that are going to be on your credit report. These are the things that factor in to your FICO score. Okay, so again, a credit score is a number that summarizes your risk. Okay, and can change due to factors. And then those factors are based on the things that you do and your behaviors. So if you're a person who doesn't pay their bills on time every month, that's going to be a factor that will affect your credit score. Now, your FICO score can range from 300 to 850. Okay, and if you want your credit score to rise and be closer to the 850 range, then you need to change your behaviors. Because again, your credit score changes due to certain factors, and those factors are based on you and your behavior. Now, I know it's probably easier said than done, but as important as credit is to our lives, then change is something that we're going to have to do. So if you know that you use your credit cards almost to the limit, then that's something that you're going to have to change. If you realize that you can't handle responsibly the use of credit cards, but you don't want to close them because closing them can negatively affect your score, freeze them in a block of ice in the freezer until you're finished paying them off and leave them open. And then set them up for something that you would pay for anyways out of your monthly budget. You pay your cell phone bill every month. Maybe you can have that come off your credit card and then just pay your credit card. So that shows usage and payment history, but it's also responsible because you're paying for your phone bill anyways every month. Might as well set it up that way and learn how to use your credit more responsibly. If you keep them frozen in the freezer in a block of ice, you're not tempted to go shopping and use them somewhere else. So now I'm going to talk about the 5 factors that make up your FICO score, excuse me. The first one is payment history. So 35% of what makes up your FICO score is your payment history, the timeliness of your bill payments, and that includes late payments, bankruptcies, and delinquencies. So this is why it's very important to pay your bills on time, all the time, every month, okay? Because that makes up the largest chunk of your FICO score. The next 30% of what makes up your score is the amounts that you owe. So, what are your balances on those accounts that you have open, especially credit cards? Okay, you want to keep your balances well below 30% of what your credit limit is. So, keep them low. Also, how much do you owe on installment loans? Now, installment loans would be a car loan, a student loan, or a mortgage. Okay, those are things that you pay off every month. You pay every month until it's completely paid off. With credit cards and store cards, those are revolving. And you can continue to use and pay and use and pay even though you still have a balance on it. You can still charge. So, how much are that you owe? What is it that you owe? What are your balances compared to your overall limit? 15% of what makes up your score is credit history. Okay, this takes into account how long you've had these accounts open and how often you use them. So that's very important as well. 10% of what makes up your score is new credit. So opening a number of new credit accounts over a shorter period of time may be detrimental to your score. So every time you open something new, your score may take a little hit. And then lastly, the last 10% is the types of credit in use. So again, do you have a healthy mix of credit files open? And that goes back to the revolving and the installment credit. All right. And are you using them and paying them properly? Are you keeping your balances low? Are you paying on time every month? So all of those 5 things factor into what make up your FICO score. And if you're doing what you're supposed to be doing properly, on time payment history, low balances, not applying for new cards, a healthy mix, you've had them open for a while and you use them responsibly, then your score can increase. Okay? Now, next month's Lunch and Learn is all about credit, rebuilding credit, how to establish credit, what to see about credit cards. So I will be getting into credit more deeply in next month's Lunch and Learn. So if that's something that you want to know about, you can feel free to go onto the website and register for those. Now I'm going to talk about money. Okay, and it's very, very, very important. We've touched on credit. We're going to discuss the good stuff, money. How am I going to buy my home on the salary that I have? Okay, these are a few of the questions that you're going to want to ask yourself. How much of a mortgage can I afford? There are a lot of mortgage calculators out there, and you can find mortgage calculators on Prince George's Community's Federal Credit Union's website under the Resources tab. And these calculators can help you get an idea of how much house you can afford or what your mortgage payment might be, depending on how much of a percentage of down payment you put down. All right? How are you going to cover all of the financial costs associated with buying a home? The appraisal, home inspection, down payment, closing costs. There are fees for practically everything. There's an application fee. There's a fee to run your credit when they do it. Okay, how are you going to cover all of these costs? So these are questions that you need to sit down and ask yourself and seriously consider, what am I doing? How am I going to be able to do this? And make use of those financial calculators on the website. They're great. They're great tools to help you get an idea of maybe how much you would need to put aside every month to get to a certain percentage of down payment that you wanted to have, how much of a mortgage you can afford comfortably on the income that you have coming in. Okay? These are the things that you want to use. They're there for your use, they're there to help you. So make use of them. All right? So, in order to get our money right and where it needs to be, we need to have a budget. And you cannot achieve a financial freedom without having a budget in place. Okay? So again, in order to be able to afford all the costs associated with home purchase that I just mentioned on the previous slide, you need to have a budget in place. Okay, so how do you create a successful budget? Well, first things first, establish your savings goals. What are you saving towards? So in this case, I'm saving towards my down payment for my home purchase. I'm saving towards what my closing costs are supposed to be. I'm saving towards home inspection, title, all of these things that need to get paid for. So that's what your goal will be. The next is to know your net monthly family income. And net, again, is what you bring home after taxes. Now, your lender, yes, they're going to look at your gross income, but in order for you to create a successful budget, you need to be looking at what you're bringing into the household. Okay, you want to base your budget on this income amount, so your net income coming in. The next thing to do is know what your expenses are and start tracking them. There are 3 different types of expenses that everyone has. The first is fixed expenses. fixed expenses are things that you need. You know how much they're going to be every month, and that's how you're going to budget those. So fixed would be your rent, your car payment, your car insurance. In some cases, your cell phone bill, because a lot of people now have plans that they know how much their bill is every month, and your cell phone is something that you need because house phones are pretty much obsolete these days, and not a lot of people have them. Everyone has a cell phone. Most people have a plan. They know what their cell phone bill is going to be every month. So those would be your fixed expenses. You know what they are, they don't change, and that's it. Then there's flexible expenses. Flexible expenses are things that you still need as well, but they range in price on a month to month basis. So your groceries, your utilities, depends on usage, gas for your car. We never know how much gas is going to be because gas prices are always up and down. You may drive more this week than you did last week, so you may end up putting more gas um, this week than last. Okay, so those are flexible expenses. You need them, but they vary on a month to month basis. And then the last type of expense is discretionary expenses. Now, those are things that you want to do: going out to eat, going to the movies, getting your hair done, your nails done, your eyebrows done. Those are things that you want to do. Subscriptions, you're subscribing to magazines or newspapers, um, the gym, etc. Things that you want to do. Now, sometimes if it's a subscription, you know how much it's going to be every month. But as for the rest of it, it may be a little different. You don't you don't know how much the movies are going to be. You don't know how much dinner is going to be. All right? So those are things that you want to do but don't necessarily need to do. So once you have all of your expenses, all of your income, you're going to subtract your expense total from your income total. All right. And you're either going to be in the positive or you're going to be in the negative. If you're in the positive, then great. You're doing something right. You have money left over at the end of every month. If you're in the negative, then your expenses outweigh your income. Now, what are you going to do? Are you going to find ways to earn additional income, or are you going to find ways to lower your expenses? Most people aim for the lowering the expenses, and usually the first ones to go are those discretionaries. So, again, make your 1 month budget, see where you are. And always remember, when you're budgeting, include savings. Okay, remember to pay yourself first. It's like paying a bill. How much money are you putting towards savings in that budget? So you want to include that in there. Then track your expenses and income from 1 month and see if the amount that you budgeted equals what you actually spent. And evaluate your spending choices. And again, decide whether you need to increase or decrease your budget in particular areas. Continue to refine your budget so that the budgeted amounts and the money actually spent are more consistent over time. Once you continue to do it, it'll start getting easier. You'll realize where money's going. You may have been spending frivolously over here, and you could have been putting that towards something more important. And the more important in this case is home purchase. You want to get yourself ready so when you go to your lender and you sit down, you're like, okay, all right, my credit's good, my savings are good, I have all my paperwork in order, and you can go from there. And then once you've been doing your monthly budget and everything's starting to fall into place with that, then you want to develop a yearly budget customized to your family's needs and to meet your savings goals. Okay? So the next thing to do is figure out the keys to successful budgeting. And the first thing is include the whole family. Everybody has to be on the same page when it comes towards working to this goal. So if you and your significant other are looking to purchase this home together, but you're the only one maintaining the budget, saving and putting aside the money, and every time they get extra money, they're spending it on something, you're not working towards the same goal. And then there's going to be resentment and hostility there. So you want to include everybody to work towards that same goal. Again, decide what your goals are. In this case, home purchase. It could be anything: sending the kids to school, taking a vacation, perhaps buying a new car. But we're working towards buying our home. Pay down your debt. If you can put extra towards getting it down, then do so. If you were on the webinar earlier before this, remember your lenders are going to look at your debt to income ratio. You want to make sure your debts are a lot lower than your income so they could comfortably be like, all right, this person can afford a mortgage every month. They keep their debts low, they're under control. I'm willing to lend them this amount of money so that they can purchase their home. Always include a savings reserves. Okay, a lot of lenders nowadays require that you have at least 2 months of mortgage payment saved in the bank after completion of the purchase. So that doesn't include your closing costs, your down payment, and all those other fees. They want you to have that money put aside to be able to manage 2 months of mortgage payments just in case something happens. Okay, and life does happen. So you want to have that rainy day fund put aside. Always keep good records when it comes to this as well. Where is all the money coming from? Where are those deposits coming from? Where are those withdrawals going? Keep good records. Have everything documented, especially for a home purchase. They want to see where everything's coming from and where it's going. And lastly, remember that it takes time. It doesn't happen overnight. The only way that you can purchase a house quickly and easy in a hurry is if perhaps you hit the lotto or, God forbid, a rich family member passes away and leaves you all their money in their will. Then maybe you'll be able to get through the home purchase a lot quicker because you don't have to rely on a lender lending you money. You have the money to do it on your own. But if you are doing this, you want to take your time and make sure that you're doing it right. It doesn't happen overnight. So when you're budgeting, you're writing everything down. You start to see, well, I was spending money on this. I didn't realize I was doing this. You want to monitor your spending habits and obviously keep a good record of the money that you spend during a 1 month period. And then you want to answer these following questions. What patterns can you see in your spending habit? What causes you to spend money? How do you decide what to purchase? Okay, are you an emotional shopper? Do the nice flashy signs and the sale signs get your attention in the store to buy stuff, right? These things were designed to get you to spend money. Okay, I used to work in retail. I know a lot about it. I used to be a visual merchandiser, and we put these things up to grab your attention, to get you into the store, so that way you can spend your money. So, how do you decide what to purchase? And what factors influence your purchasing decisions? Are you an emotional shopper? Just because it says sale, you're like, let me get this. Just because it says sale doesn't necessarily mean it's a good value, that it's worth spending the money on. Okay? So write it down, see where it's going, try and figure out what it is that you're doing. Okay, why am I spending money on this? Can I put my money towards something better? Which in most cases, there's always a yes. The answer to that question is usually yes. Can I put my money towards something better now? Of course you can. Savings, paying down debt, the down payment for your home, your closing costs, it can go towards something better. Ask yourself, do I really need this item or can I do without it? All right? We want to make sure that we are financially ready before we walk in to the bank or our credit union and sit down across from the mortgage officer, the loan officer. We want to make sure we have, again, all our ducks in a row, all our T's crossed, all our I's dotted, because this is a process. They want to know that you are financially ready, financially stable to make this purchase. It's going to be one of the largest purchases you make in your lifetime. Are you ready for it? Have you been putting your money away? Have you been working on your credit? Super important. You'll see a lot of places that say, oh, we can get you in a house with a 550 or a 520 credit score. What are your terms? No, you want to be with a reputable institution. Yes, your credit will obviously have to be higher, but you will get better terms. It won't be predatory. You want to make sure that you are on the right track. Now, if you were on the last webinar, remember that the credit union is having a home buying workshop. All right, you can get a lot of great information at these home buying workshops. They're having it Saturday, March 24th from 10 a.m. to 11:30. Okay, you can always call, you can visit their website to find out more information. But homebuyer workshops are a great way to get started. If you can't make it to the credit union, check out a HUD approved housing counseling agency. They have homebuyer workshops as well. They'll let you know what you need to do, the steps that you need to take, where you need to be financially. You can work with a counselor and have them help you get mortgage ready. Perhaps there are down payment assistance programs or closing cost assistance programs out there for you that can help you with the purchase of your home. So you want to make sure that you have all of your information, you have all your ducks in a row. If you are trying to get down payment assistance from the city or the county or the state that you're living in, remember, they require you to have some savings. So if you're not budgeting and putting your money aside, they're not going to be able to help you. They require that you do have some savings in the bank. Depending on where it is, it could be anywhere from 1% to 3% of the purchase price. So you need to be financially ready. You need to make sure you're budgeting and putting your money aside because that's the only way that you're going to be ready in order to sit down across from your mortgage lender and get yourself prepared for this purchase. Now, there's this last slide. I want to let you know, not the last slide, but stop spending on autopilot. People don't realize how quickly money goes. I always like to say it's hard to make it, easy to spend it. It goes super fast. Every time you put gas in the car, pay the lawn or pool service, rent a movie, or grab a soda, a Starbucks, whatever, write it down. Make sure you don't leave anything out. The key to good budgeting and knowing where your money's going is to include everything you spend money on. Look back over your check stubs or your bank statements to see where you've been spending. It's very important to manage your money properly when you're looking to purchase a home. You need to track every penny that you're spending and make sure that you're working towards saving and paying down debt. Now, as you can see on the screen, if you spend $7 a day in snacks, food, Starbucks, Dunkin' Donuts, whatever, it adds up to over $2,500 for the course of the year. Now, spending $7 a day doesn't seem like a lot to everybody. It's like, oh, it's only $7, or it's only $5, or it's only $8. It adds up. If you were to put that $7 a day away for a year, that could be your 1 to 3% if you're looking for down payment assistance. That could be money towards your closing costs. That could be money towards your home purchase. Okay? Challenge for each and every one of you on the call today. Make sure every week, I don't know if you buy lunch, if you brown bag it, but take 1 day a week and make it a no spend day where you don't spend any money whatsoever. And the money that you would traditionally spend on an average day, put it into a jar or a savings account, put it somewhere and watch it add up. And then once you get through that 1 day a week, take it to 2 days a week, then take it to 3 days a week, till eventually you're maybe at 4 or 5 days a week where you don't spend any money. Yes, there's going to be times, okay, we have to put gas or whatever, but dedicate a day right now. This is your challenge. Dedicate a day every week where you don't spend any money whatsoever and see if you can start putting that money aside. All right, work towards that goal, work towards that home purchase. Okay, remember, this is what we're working towards. This is what we want to do. We want to buy our home and we want to be comfortable. Now, this last slide is just so that you can see if you're renting how much money you're spending every year, how it adds up. If your mortgage payment was about that month every month, you're putting equity into your home. Okay, so for example, if you were to pay $1,100 a month in rent and you live there for 3 years, that's almost $40,000 right there that you've practically given to somebody else. You're either A, making somebody else rich, you're paying somebody else's mortgage, something. Okay, especially if you're renting from a private renter and someone who either owns a condo or owns their home and you're renting from them. If you're paying $1,100 a month and you've lived there for 3 years, $39,600. All right, so this chart is just here. It's a bit of an eye opener so that you could see where you're at. And the way rent prices are going, some of those amounts aren't even on this chart. So you can imagine how much you're spending on a yearly basis. All right. So this is just something that's there to give you an idea of where your money is going. If you were on the last call, remember, get yourself ready, follow those mortgage 10 commandments. Don't spend extra money. The money that you have put aside for your closing, save it. Do not get rid of it. All right, I'm going to open up the call for any questions that you may have. Again, please feel free to type it into the question box on the right-hand side, and I will be happy to answer them for you. So I'll give you guys a couple of minutes if you're going to type and ask any questions. If you do want to ask a question and you're typing, if you could just hit the little raise hand button so that I know you're doing something and I won't jump to the next slide. Okay, we have a question coming in. So I'll hold on and I'll wait for that question. I know it takes time to type, so I'll give you guys a couple of minutes. Hopefully you're getting a lot of valuable information out of these webinars. And remember, if you want to know more about credit, next month's Lunch and Learn is all about credit, establishing, rebuilding, how to deal with debt collectors, etc. So it's all about credit. I'm not sure if you changed your mind about the question, but I don't think anything's coming in. Okie dokie. All right, well, there it is. All right, so what are ways to save without putting money in a jar? That's a great question because, again, if you were on the previous webinar, you know that lenders want you to have an account for where the money's coming from. So if you're saving money at home, in the freezer, in the backyard, under your mattress, they're going to ask you where it came from. You can't just have a large lump sum. So a great way to save would be to have a high interest bearing savings account. You always want to look for savings accounts that have the highest interest. And from what I've seen, a lot of online accounts have higher interests. You could check out sites like bankrate.com or even nerdwallet.com to find out which savings accounts have the best interest rates and start deducting out of your paycheck, just like a direct deposit that you have into your checking account, direct deposit into that savings account. It's recommended that you save about 10% of your income every month. If you cannot start with 10, because it's hard for some people, not everybody gets paid a lot of money. Start with 5, start with 6, start with 7. This is the whole point of budgeting. Once you start to budget, make changes, cut back, you could start putting more money towards your savings. So you want to look for a high interest bearing savings account. One that compounds the interest would be great as well. Direct deposit straight into there. Set it and forget it. Leave it alone. Let it build. Let it gain its interest. And then this way, when you do go to your lender and you fill out your application, you have an account, you have statements to show them, and they could see where the money's coming from. Because again, they want documentation for everything. When it comes to working with lenders and home purchase, there needs to be a paper trail. So if you do have money right now that's in a jar or under your mattress, put it in the bank and let it sit there and continue to let it grow. Don't wait until the last minute to put it in. Okay, so any recommendations for those just beginning the journey to save? Yeah, so like I said, again, do your research. Bankrate.com is a great site. Nerdwallet.com is a great site to see those high interest savings accounts. And again, start small and work your way up so that you're comfortable. And usually when you direct deposit into a savings account, once it starts going, after the first couple of weeks, maybe the first couple of months, you don't even realize it's going anymore. It's just like second nature. Because when they tax you, you don't realize what's coming out. You don't technically paying attention to everything that's coming out. You're being taxed. It just happens. You know it's going to happen, and you expect your check to be around a certain amount after taxes. So if you start direct depositing into a savings account, again, you're just setting it and leaving it alone. It'll be like second nature. You're not even going to pay attention to it anymore. You know it's coming out, but it's not something that you're worrying about. So that's a great way to start. It's always start small and work your way up. Many financial institutions have a high minimum balance. There are some that do have high minimum balances, yes, that you need to have in your account or else they'll charge you. Again, I'm not sure what the credit union offers on their savings. You may want to call, there's a number at the end I'll give to you guys to speak to a member services representative. But like I know for most of those online accounts, you could start with savings as low as $1, sometimes zero to open the account, and you don't have to have a minimum balance on there in order to have your account open. All right. So again, do your research, call and speak with a member services representative. If not, check out the sites that I had said earlier and find out from there because a lot of those online accounts, like I said, they offer you a 1.2 or sometimes a 1.4. I've seen as high as 1.59% interest on your savings on the money that you have in there, whereas traditional banks, etc., only offer you maybe a zero point 0.5 or a 0.10% on interest rate. So those are the things that you want to look into. Okay. So hopefully I've answered all of your questions. You're very welcome. If there are no more questions, we will bring the webinar to a close. Okay, so I would like to thank you for attending today's educational webinar. To learn more about Prince George's Community Federal Credit Union or to speak with a member service representative, please visit www.princegeorgescfcu.org or call 800-952-7428. And again, you can ask them questions about their savings accounts. They have higher saving yields, so you want to see what their interest rate is, and if it's compounding, that would be great for you. To schedule your free 60-minute financial coaching session, please call Coffee at 866-459-5165. And if you enjoyed today's webinar, please be sure to visit www.princegeorgescfcu.org/lunch and learn to check out a list of topics for the year. So thank you all again, and I hope you have a great